Hello and welcome to CNBC-TV18. I'm Arundhati Ramnan and these are the top headlines that we're tracking for you this evening. Infosys largely meets estimates in the second quarter, raises the full-year guidance for revenue and margin, also clears a 9,300 crore rupee buyback. Stock markets wobble across the world ahead of the US inflation data due later today. Sensex loses over 400 points, Nifty loses over 100 points. Rupee remains on a tight leash against the dollar. Negotiations between India and the UK over a potential trade deal could extend beyond October, even as both nations were hoping to finalize an agreement by Diwali. The UK Trade Department tells CNBC-TV18 it won't sacrifice quality for speed and will only sign a deal when the interests of both nations are met. Indian startup funding hits a two-year low in the September quarter amidst the global slowdown, according to a PwC report. But early-stage funding remains upbeat, accounts for 21% of the total funding as venture capital firms continue to back the Indian startup ecosystem. The Supreme Court delivers a split verdict in the Karnataka hijab ban case. One judge upholds the ban, but the other calls wearing hijab a matter of choice. Chief Justice of India is likely to refer the matter to a larger bench. The hijab ban is likely to continue in the interim. Well, those were the headlines that we're tracking for you this evening. Let's start with the big earnings of the day. Infosys reported second quarter numbers that were largely in line with estimates. Margin expansion was above estimates, but revenue growth missed expectations marginally. For the full year, Infosys has raised the upper end of its revenue outlook from 22 to 23%. However, the upper end of the margin guidance has been lowered from 23% to 22%. Ritu Singh spoke to Infosys CEO Salil Parekh on the earnings report and his outlook for growth. Take a look.
Mr. Parekh, thank you very much for speaking to CNBC-TV18. First, as always, on your guidance, both revenue and margin have been tightened. What is the reason for that and what should we infer from it?
On the growth guidance, we've seen as we go through the quarters, normally we reduce the band of the guidance as we see more visibility within the full financial year. We've seen very good large deals momentum. We've seen good pipeline and a good Q1 and Q2 on growth. And there we've made the guidance in the top end. So we had 14 to 16 and now we made 15 to 16, which is at the higher end of the guidance, which gives us more confidence and visibility of what is going on within the year. On the other one, margin guidance, last quarter we had said that our guidance was 21 to 23%, but that we would be closer to the lower end of the guidance. As we've come in here for this year specifically, since we felt we were going to be at the lower end of that, closer to the 21%, in the guidance, we've decided to reduce the band so that it's clear what we are saying on the guidance. In most years, we don't change the margin guidance. We keep it the same because our aspiration, and even for next year and the future, will always be to higher margins.
You know, the macroeconomic environment, and you've been outlining this as well, has remained challenging, especially in Europe. Could you tell us what the conversation with clients have been like? You said high-tech and telecom are some of the sectors which are seeing stress. Is that only in the European market or in the American markets as well?
So there, the environment is got many different aspects. So first, if you look at what Infosys is doing with supporting our clients, we are seeing growth in both digital, over 30%, and growth in our core services. So we have now really two engines, both of which are growing for different reasons. We see that our digital capabilities and Cobalt are extremely resonating with our clients, and our automation is also working because there are cost impact that we're having. Now that, if you superimpose on the macro, what we said last quarter was the mortgages in financial services, parts of retail industry. Now we are seeing parts of high tech and parts of telecom, where some of the discretionary spend are coming down. However, we are also seeing our large deals value for Q2 at 2.7 billion.
But is that sustainable, the 2.7 billion kind of a run rate?
So there we are seeing a pipeline for large deals extremely large. Now, why is that? Because the earlier point, which is both digital and cost, are both in our playbook. And depending on how the macro develops, we will see which ones will be more important for clients. And that's why that sort of point always needs multiple components, because there's no simple way for us to get that, communicate that.
A quick word on the employee addition for the quarter, around 10,000, which is slightly lower than the run rate we've seen in the last 4 quarters, at least 16,000 plus. Could you give us a sense of how we should read those numbers as well? Is it a sign of the kind of headwinds you see, or are you expecting higher furloughs in the third quarter, as usually is the case?
So, as you said, in the third quarter, there's typically furloughs. We don't see any indication of a change in terms from the past years of what the quantum will be. But there are always furloughs, so that seasonality comes in. But the recruiting at 10,000 is a very strong number, and we've already had, as you mentioned, good recruiting in the last few quarters. Last year we had 80,000 college graduates. So we continue to see that we are adding to our employee base, but we're also making sure that the macro points we discussed earlier, we're keeping that in mind.
But has the onboarding been delayed, as some reports seem to suggest?
So we have made sure that all of the campus hires that we are doing are joining Infosys. Some of the training are at different times in the year.
All right. I also wanted to get a sense on attrition coming down. Yes, it's been trending lower for the last 3 quarters, but how soon do you see it coming below 20%? And first that and then another one.
So on attrition, again, there have been several initiatives the companies put in place. I think in combination, they're starting to work, more predictability, changes in leadership development, learning. So that's what's given us this trend down.
Yeah.
My sense is we will continue to see the benefit of these initiatives, and over time that will show up in better attrition.
And we have to ask you about moonlighting. It seems to be the term of the season. Have you let go of any employees because of this, and what is your opinion on the matter? Stand, rather.
There, I shared earlier what our approach is. I think our view is, Infosys is a hugely focused learning environment company. Internally, we have for years a system that we had set up for gig work, where employees can do things beyond what they're doing in their job, apply for these things. We've had in any given quarter 4,000 employees who apply for it, 600 who get it. So it's something which we're very familiar, comfortable with. It's a platform we call Accelerate.
Yeah.
For external gig work, we have got an approach where with the prior permission of our manager, keeping in mind confidentiality and contractual, the employees are allowed to do that. That we are also making the policies more comprehensive on that, so it's very simple for our employees to see it. However, to be very clear, we are not supporting dual full-time employment. So that is sort of in summary what we're doing there.
And finally, a word on your buyback. What went into the quantum and the mode of the buyback, if you could just clarify for us.
So the buyback, we are very committed to our capital allocation and return policy. The policy states 85% of free cash flow over 5 years. So given the way the buyback cycles work within the regulatory environments, we anticipated that we would have some buybacks and some dividend payouts. And in keeping all of that in mind, the quantum was developed, which the board recommended. So it's a large quantum at 9,600 crores, and it will now, we've announced it, so it will now be rolled out.
All right. Thank you, Mr. Parekh.
On that note, it is time for us to head into a short break. But coming up next, the Supreme Court delivers a split verdict in the Karnataka hijab ban case. Details when we come back. Stay tuned. Welcome back onto the big national story of the day. A two-judge bench of the Supreme Court delivered a split verdict on the Karnataka government's order banning hijab in educational institutions. Now, one judge upheld the ban while the other called wearing a hijab a matter of choice. The ball is now in the court of the Chief Justice of India, who is likely to refer the matter to a larger bench. In the interim, however, the ban on hijab is likely to stay. Ashmit Kumar is here with the highlights of the court order and its implications. Ashmit?
It was a little more than 8 months back that the schools and colleges in Karnataka made the national and international headlines, the reason being trying to enforce a ban on hijab. Now, after polarizing debates, fierce politicking and several hours of judiciary's time, we are no closer to an answer. Let's in fact trace the movements of this debate. On February 5th, the Karnataka government passed an order to ensure a more homogeneous environment. The order barred all clothing articles that disturb equality, integrity and public order. The language may have been innocent, but the intent was clearly to take aim at the hijab. Now, the government order sparked protests both for and against the ban. The issue was then taken up before the Karnataka High Court. The High Court affirmed the government ban on hijab and held that this is not an essential practice in Islam and need not be given any special consideration. Now, the issue then travelled to the Supreme Court. Muslim girls claimed before the top court of the country that their right to education and their right to freely practice their religion was being affected. The Supreme Court heard the case, marathon hearings across 10 days, and reserved its judgment on September 22nd. It was this judgment that was pronounced earlier today. Now here, important to bear in mind that the judgment was to be pronounced by a bench of two judges. That's Justice Hemant Gupta as well as Justice Sudhanshu Dhulia. Now, keeping this in mind, the Supreme Court has now given a split verdict. Both the judges have given a different view on the status of the hijab ban. While Justice Gupta has upheld the ban, Justice Dhulia has quashed the Karnataka government order. Now, Justice Hemant Gupta held in his judgment that, in his view, the plea by Muslim students deserves to be dismissed. He clarified in the judgment that the petitioners had failed to demonstrate how wearing a hijab was an essential practice in Islam. Moreover, he held that there was no violation of any fundamental rights. However, in stark opposition, Justice Dhulia held that the Karnataka government order as well as the Karnataka High Court order upholding the hijab ban both deserve to be quashed. He held that wearing hijab need not be an essential practice, but that it was supported by the right to life under Article 19 and the right to practice religion under Article 25. He cautioned that this was an issue of students' consent and that this was the foremost thing and the foremost concern on the court's mind was education of students. In fact, he also noted that many students, especially in rural areas, have to attend to chores at home and travel long distances to schools, and that the effort of the court should be to make this process easier. So what happens now? Well, due to the split verdict, the issue has now been put before the Chief Justice of India, who's likely to assign the case to a larger bench, likely to have at least 3 judges to avoid this tie. As for the interim, lawyers that we spoke to tell us that until a clear order is passed staying the High Court order, the ban on wearing hijab will continue to be in effect. Meanwhile, given the stakes involved, that's an entire academic year for students, the petitioners are likely to move the CJI to constitute a new bench at the earliest.
All right, Ashmit, thank you so much for those details. Now, even as global crude prices ease from their peak, the price of petrol and diesel at the fuel pump has not changed since early April. Sources in the government hint that retail fuel prices have not been reduced primarily to balance out the losses booked by oil marketing companies who have purchased crude oil at higher levels. Timsi Jaipuria is here to explain the fuel excise mat. Timsi?
Well, the retail fuel prices moved last in early April, with OMCs revising the rates based on global crude oil prices movement. And then on 22nd May, when Union government decided to ease high petrol and diesel prices for consumers by cutting Centre's share with 8 rupees per litre cut on petrol and 6 rupees per litre cut in diesel. But since then, no price revision has happened when it comes to petrol and diesel. Let's see how the levies have moved. What are the current central levies that we actually pay? Firstly, Let's look at the past excise changes that have been announced by the government. Here are the last 3 movements on account of central excise levies. Well, the last one came in May this year, where 8 rupees per litre on petrol was cut and 6 rupees per litre on diesel was cut. Prior to that, a cut was announced just on the eve of last Diwali. This was again 5 rupees per litre cut in petrol and 10 rupees per litre cut in diesel. But the levies were hiked too. It was in May 2020 when, on account of COVID-19 pandemic, to shore up funds to meet up the requirements of health emergency, the government had levied 10 rupees per litre of central excise taxes on petrol and 13 rupees per litre on diesel. But these excise cuts need to be seen with the global fuel prices, the global crude oil prices movement. Since the last excise cut that was announced by the government was based on the Brent movement, since then Brent crude oil prices have come down by 23%, and under the deregulated price mechanism, the prices should have moved, but there has been no revision announced by the government, neither by the retailers. So let's see where are we when it comes to the central levies. How do we pay on per litre of petrol? Well, when it comes to the share, the basic excise duty on per litre of petrol is 1.40, special additional excise duty of 11 rupees per litre on petrol, and road and infra cess of 5 rupees, and agri infra and development cess of 2.50 rupees, coming down to 19.90 rupees that we pay on per litre of petrol to the central government. Similarly, when we see diesel we pay around 15.80 rupees per litre to the central government, which is again divided on these heads. 1.80 rupees per litre of basic excise, special additional excise of 8 rupees, road and infra cess of 2 rupees per litre, and agri and infra development cess of 4 rupees. Also important here that how much does the government earn from these levies? Well, government in May this year has earned about 30,730 crore rupees, another 30,000 odd crore rupees in June, 23,919 in July, 28,816 in August, and 25,962 in September. Remember, these are indirect taxes. They are paid with 1 month lag. So these are for the consumption patterns of the previous month. Also important apart from this, when it comes to how much would it cost the government or the exchequer if 1 rupee per litre of diesel or petrol is cut, where centre decides to give up its share. In that case, government is going to lose around 1,300 crore rupees per month based on the March consumptions. So let's see how these central levies continue to earn for the government and whether government decides to give any further relief or not.
Well, we'll have to wait and watch for that. Thank you so much for those details, Timsy. Now, Mumbai is getting ready to kick off a brand new cruising season. And this year, with more people getting ready to head out on vacation, over 4 million passengers are expected to board cruise ships across the country. With the Ministry of Shipping projecting that India's cruise market could grow tenfold in the next decade, CNBC-TV18's Jude Sanit finds out how cruise companies and travel agencies are looking to change the country's cruise waterscape. Take a look.
This is the Empress, a luxury cruise liner owned by Cordelia. With the southwest monsoon petering out, the cruise company is all set to resume its west coast itinerary, starting with putting Mumbai, Kochi, Goa and Lakshadweep on the cruise map. Cordelia says it expects to carry 120,000 passengers over the next 8 months. The company says all signs point to cruises attracting more vacationers every year, and hopes to operate as many as 5 cruise ships over the next half a decade.
We look at a 3 to 5 ship operation the next 3 to 5, 6 years. So we would like to grow the market to 2 million passengers. We also want to grow employment by 200,000 at the same time.
A lot of Cordelia's optimism comes from India betting big on cruising. The Ministry of Shipping has projected that India's cruise market could grow tenfold in terms of passenger count over the next decade, hitting valuations of a whopping $5.5 billion. And a lot of that success is already trickling in. For the first time, the Empress serviced the Chennai-Vizag market between June and September, ferrying 49,000 passengers. During this time, Cordelia reported a 100% load factor for its 2-day cruises and 65 to 85% occupancy for the 5-day getaway. Cordelia is now charting a course that will give it control of 50% of the cruising market, swelling its passenger count to 2 million. The rising penchant for cruises has online travel agencies scrambling to offer bookings and are factoring this craze into their own growth prospects.
Quarter on quarter, if we grow about 15-20%, I think is a good number for us internally on the cruise. We believe at least 10-20% of the business should eventually move into cruise as the organization matures and the market also matures.
Increased interest in cruises has prompted other cruise companies to set sail for Indian waters, with names like the Royal Caribbean and Disney Cruises ready to drop anchor. Experts believe this could well be the start of a lot more ships cresting the horizon. In Chennai, Jude Sanath.
And with that, it is a wrap on this edition of CNBC-TV18 News Now. Many thanks for watching. More news and updates continue on the other side.